Hello, and thank you for watching this month's Dechtman Wealth Management Financial Insights. In this month's video, I'll discuss some of the major headlines that influenced markets in February. I will also provide insight into what these developments could mean for you as an investor. Domestic markets started 2018 with their best monthly performance since 2016, only to stumble in February. Both the S&P 500 and Dow had their first monthly losses in 10 months, breaking their longest winning streaks since 1959. Overall, the S&P 500 lost 3.9%, the Dow dropped 4.3%, and the Nasdaq gave back 1.9%. These losses came as volatility picked up throughout the month. In early February, we experienced back-to-back stock sell-offs followed by large jumps. During 1 week, the Dow lost 1,000 points and gained back 300 twice. But this volatility wasn't the result of negative economic data or geopolitical problems. Instead, a combination of emotional investing and computer-generated trading may be to blame. Essentially, investors became concerned about inflation when the labor report indicated that wage growth was picking up. In other economic news, we received a variety of positive and negative reports. The most recent data for housing showed both new and existing home sales dropped in January. Housing starts, on the other hand, hit their second highest rate since the recession. We also received the second reading of fourth quarter gross domestic product, or GDP. At 2.5%, the growth matched expectations. Ultimately, though, worry about inflation and the resulting potential for interest rate increases contributed to much of the month's volatility. By the end of February, comments from new Federal Reserve Chairman Jerome Powell had led some investors to believe interest rates may, in fact, rise faster than anticipated. In testimony to the House Financial Services Committee, Powell spoke of growing global strength and stimulating fiscal policy. He also said that inflation may be moving closer to the Fed's target rate. This positive view of the economy could potentially result in 4 interest rate increases in 2018. On February 27th, stocks dropped significantly in response to Powell's testimony. The volatility continued the next day as stocks went back and forth before ultimately ending down. If February's volatility feels unnerving, that may be due to the market's unusual calm last year. Since 1980, the average annual S&P 500 correction has been approximately 14%. Last year, however, stocks only fluctuated 3%. When considering last month's fluctuations, let's remember that positive economic perspectives were behind much of the movement. Despite the volatility, consumer confidence easily beat expectations and showed that people feel particularly good about the labor market. Jobless claims supported this perspective, as new unemployment filings remain near historical lows. Moving into March, we'll pay close attention to inflation, interest rates, and investor behavior. On March 21st, the Fed may raise interest rates again and provide greater insight into their expectations for the year ahead. As developments arise, we will keep you informed. That is all I have for you this month, but don't forget to tune in next month for another economic and educational update from Dechtman Wealth Management. If you'd like to discuss your personal financial situation, please give us a call today at 303-741-9772. We look forward to speaking with you.